Chris Conway from the Australian Stock Report, live in our Melbourne studio. Chris, welcome. The PE discussion around a lot of these bid-up plays now, just sort of taking Goodman as perhaps one instance of that. Just talk to the broader expense that you are now being required to pony up for if you're coming to this market belatedly, and how much good value is left in your estimation.
Good afternoon, Carson. Good afternoon, Martin. Yeah, look, I can't talk to Goodman, unfortunately. It's not a stock I cover, gents. But more broadly, the market PE at the moment is about 19.6. Historically, we know it's about 15. So I think you could say stocks aren't cheap. They're not ridiculously expensive yet. But it is harder to find value. And I think that's what we're seeing with the price action recently. Again, Carson and Martin, you were talking to it in the introduction. You know, the market is sort of struggling for direction right now. If you look over the last 2 years, momentum has been the dimension that has been most profitable for the Australian market. You know, buying stocks that have been performing well has served you well, but the market can't break higher from about 58.30, and we've been stuck in this range now for a couple of months. So that has dried up. But then again, value isn't there either, because as I was just talking about, the PE of the market is higher than it's historically been, and growth's not there either. So there's a real wrestling match going on. You turn to some of the other elements of the market, say in commodities, the same thing is happening in iron ore, where it's bottomed out, but you know, struggling to break higher after a nice bump. And oil as well is very much rainbound, and there's a lot of push-pull factors there that are, you know, diametrically opposed. So I think everyone's sort of in hurry up and wait mode just to see what's going on with the market, and reporting season will be the great leveler. I mean, that's what we're all waiting for.
Well, Martin, yeah, resource companies drove the action last reporting season. Now, do you think that this is a story where they can still be talking about bigger margins on the back of higher commodity prices, or the thematic will shift? What will be the sort of hymn sheet?
Yeah, it's interesting. I mean, we think a couple of things. Probably price realisation's the one topic that we don't think the market's really got its head around. You know, Fortescue is one good example where if you look at the benchmark iron ore price and then look at their cash costs, you're imputing, you know, massive free cash flow from these guys. But they don't sell at the market. They sell a slightly inferior product. And there is a significant difference between the spot price and the realised price. We'll see that with Whitehaven Coal as well. We'll see that with some of the other iron ore miners. So I don't think these numbers are going to be as good as some people in the market think. So we think there might be a little bit of sticker shock on some of the names, particularly in the iron ore and coal space. But I mean, the second part of that is, despite that, there is massive free cash flow. So the companies that have got debt, you know, Rio, BHP, etc., you know they're going to use the cash flow to retire debt, and that's good. The other guys, what are they going to do? So the South 32s, these sorts of people, what are they going to do with that money? We're all hoping it's capital management, but typically they tend to sort of get a little bit excited. They've got all this free cash flow, and they start investing it in resource projects, which is not necessarily the best thing to do. So I think they're the two things to look for, Carson.
Fair enough. Morgan's technical analyst, Violetta Todorova, has got a PET of 620 in the medium term. Say it could make a run towards that. But I'm just wondering what you're doing in the interim, because the stock's rallied 18% in the last fortnight. So we are in overbought territory, are we not, Chris Conway?
Sorry, what was the stock, Carson, that you were just referring to?
Fortescue? Overbought territory,
like
having run up 18% in 2 weeks.
No, I don't think so. Martin, talking about singing from the same hymn sheet, Martin stole just about all of my talking points there in terms of Fortescue. They will generate a lot of free cash flow, 100% right. Their ability to pay down debt, you know, it's an ongoing story, but I still like that. And they might have rallied 18% in the past couple of weeks, but they were belted pretty hard before that. So I'm looking at Fortescue as a potential buying opportunity prior to them dropping numbers, because I think they will report well.
So what is the determining fate of, you know, a stock like this to say on the one hand there's still compelling value, on the other it's overbought? Martin?
It's an interesting one. You know, we've sort of been moving our views around on Fortescue a little bit as well. I mean, ideally, we buy the stock with a 4 in front of it, not a 5 in front of it. So we are looking for their quarterly in a couple of weeks as maybe a sticker shock moment where that price realisation that Chris and I have been talking about comes to the fore, and there's a little bit of a sell-off into it. So we think it's in accumulate territory. We actually have a buy recommendation on it because we have a 12-month view on our recommendations. But I think we can be a little bit more tactical and a little smart on this, wait for this quarterly to come out and look to use any price weakness to acquire the stock.
Let's shift to the big Australian. The call certainly from Deutsche is that a buyback could well be flagged in the FY18 numbers to the tune of between 3 and 4 billion. To everything you were just talking about, capital management panel, I mean, starting with you again, Martin, is that the kind of initiative you'd welcome right here, right now?
Well, I mean, it may just be a little bit premature. There's obviously a new chairman there, and everyone's looking to him to probably, shake the place up a bit and maybe look at some of the issues that some of the people like Elliott have been raising, and portfolio management's always a good place to start. So we're looking at the commodities that they're in, and do they have the scale and do they have the right assets? And obviously everyone's pointing to petroleum as an area where they might do that. I think personally, it's probably a little bit premature to expect something in this result on that front, but I think the chairman may guide the market to the fact that they're looking at it and they're having some analysis of their portfolio, and that'll probably then lead people to say, right, they're going to do something with petroleum. But I wouldn't expect an announcement this early on.
But Chris, the spectre of Elliott looms large in all announcements here. Is this part of the, I suppose, the risk you run being on alongside the story, that you're kind of hostage to the pressure that is coming off from left field all the time, and a new chair that may actually be in a rookie situation from the chairman's seat itself? He doesn't have that direct experience and may indeed overreach and beg to manage where his managers themselves then feel that they've been, I suppose, they've been trounced.
Yeah, look, I think that is the risk, Carson, that a new CEO comes in, might
new
have
chair, right? Just to clarify,
new chair.
Yeah.
Might have some hubris about him and might want to do some things to earn his, some would say, inflated paycheck. I'm a bit surprised about this talk about spinning out petroleum. I don't really see it. I don't know why you do it now towards the bottom of the cycle, and they're tier one assets as well. So, yeah, I don't quite understand the conversation. I certainly hope that it doesn't happen. But yes, it is a risk, and we all know what happened. The prime example I can think of is when Rio Tinto bought all those aluminium assets at the top of the cycle and turned out to be a disaster. So hopefully we don't see the reverse of that here with BHP. Just in terms of the stock itself, I've sold out of it recently. We were long, but we saw a nice pop in the iron ore price and a nice pop in the oil price, and I took advantage of that, just being more from a trading perspective. Just
to speak to that though, and before we move off the stock, Martin, that talk of buying assets at the top of the cycle and the fact that the chair on that bench, namely Jan, has presided ever since, through some pretty choppy times for Rio. Does that give you confidence, or you're still kind of decidedly disappointed?
I mean, I've probably got a longer time frame on Rio. I think back to CRA, and they were always such good buyers and sellers of assets through the cycle. And it wasn't until Alcan, which Chris referred to, which they really messed that one up and got that horribly wrong. Before that and since that, they've been a very good buyer and seller of assets. So I think getting out of thermal coal right now is probably the right thing to do. And they seem to have got a good price for the coal and allied assets they just sold to Yancoal. So I think they do have a pretty good track record, but they've just had one, like all portfolio managers, you get one wrong now and again. And ex-Alcan, I think they've done pretty well. So I think it's back to the future with Rio.
All right, positivity abounds on that score, notwithstanding Mr. Varley and indeed washout from Oyu Tolgoi and indeed Mr. Walsh. Let's talk Vocus, shall we, panel? You've got some thoughts on this one, Chris, in terms of KKR, tyre kicking, and perhaps this becoming more a habit now rather than what comes next. We want something firm, we want offers.
Yeah, it is. I mean, look, I haven't followed the story all that closely, but yeah, it's getting a little bit frustrating, and some of these lowball bids that we've been seeing aren't helping shareholders. So, yeah, I mean, like I said, I haven't followed the story all that closely, but yeah, it has been frustrating.
Yeah, well, Martin, I noticed that Shaw believing, the best on this, saying the share price should react well to the granting of due diligence and not at least rejecting the KKR bid, but that's not synonymous with certainty on anything to come from that, is it? Yeah, it's high risk territory.
Yeah, we were thinking that the board would outright reject the bid and that would result in KKR walking away and then the share price probably going back to where, fundamental value is, which in a good case scenario is 310, in a probably a fair case scenario is maybe 270. So the fact that hasn't happened is probably a little bit of good news for Vocus shareholders, those people that are still in the stock, that is. But, I think the market wants, as you said, all cash bids, binding all cash bids, and we're not getting those. We're getting sort of indicative proposals and highly conditional offers and so forth.
And indeed, Chris, what have we learnt now from the Fairfax failure, given the jewel in the crown's been basically, it's just been rejected?
Yeah, well, what have we learned? That any company that, even if they are under takeover speculation or bid speculation, that they should press on with what they're supposed to be doing in the very first place, and that is obviously building their brand. So I think that's what we've learned there. And again, it's this frustration around people lobbing bids. There is a bit of a worry there, though, that two companies looked under the hood and decided that what they saw they didn't like, and quickly scurried back under the fridge like cockroaches. So that is a little bit of a worry. But yeah, businesses need to keep operating and doing what they do best.
Yeah. Well, they thought it was Cartier, and perhaps PE thought it was Michael Hill, to paraphrase. And there you have it on the jewel in the crown for Fairfax. Let's take a really short break. When we come back, I want to thank you as well, Chris Conway, for that contribution. We'll lose you there now from Melbourne. Chris Conway, Australian Stock Report.